So the first part of Forex is knowing why you're trading it. There's a book by Simon Sinek, and basically with that book is called Start With Why. And the reason that book is one of my favorite books is because a lot of people try to define their life by what they're doing or how they're doing it. But what really defines you and what really drives you is why you're doing something. So knowing why Forex is such a big market, such a big opportunity is huge, because if you don't know why you're trading it, during the different learning curves or bumps you may have on the road, you may give up because you don't have a solid reasons as to why Forex. So a lot of people ask the difference between trading Forex and trading stocks, or why more people are switching to trading Forex. For example, this is a good example to know why. So say you have one stock in a company, and it costs, one stock is $50. So having one stock is $50 in the company. Now, in Forex, $50 can roughly get you 6 to 10 trades open at the same time. Now, say you have that one stock of $50 and it goes up 10%, which is great for stocks. Usually it takes half a year for a regular stock to do that. That stock 10% is $5. So you would have made $5 on that stock going up 10%. Now, in Forex, with $50, you can open 6 to 10 trades at the same time that can each make you $5. That have the potential of making $5 each. So just in using the same liquidity in a different market, at $50 is basically 6 to 10 times, I would say, more profit potential in Forex. And I'm going to show you why that is. I'm going to show you why that is. So you got why Forex. The other aspect of Forex is that the markets are open on a 24-hour basis. So you have a 24-hour markets, and basically it opens Sunday, 4 p.m. Central to Friday, 4 p.m. Central. So every hour in between those hours is tradable money-making hours. So if you're working a job, stock market is only during business hours. And if you're working a 9 to 5, you're going to miss being active in the stock market as far as trading all the time. So those things right there basically contribute to why Forex is what it is. So you got that aspect of it. The next aspect is knowing how money is made in Forex, or more so, we'll back up, knowing what is a Forex pair. So you have your first pair. Now, a Forex has 2 different pairs. So let's use 2 different currencies, and that creates a pair. Now, the first currency's terminology is different. Some people may call it the base pair, and then some people may call it the quote pair. But to make it simple, you got the first pair and the second pair. So when the first pair, which is in this case euro, the first pair is the one to the left of the parentheses. So euro, which is the European dollar. The first pair, if the euro gains value, gains strength, gains momentum, then euro USD as a whole goes up if euro price goes up. Now, you see that there's a second pair, which is the United States dollar. So how does that affect this pair? Well, if the United States dollar gains value, and it fluctuates on an almost minute by minute basis, but if the US dollar gains value, then euro USD, the price goes down because the dollar is the second currency. So we got that, and let's make sure I don't got no questions. All right, perfect. So euro USD price goes down. So when you're selling, so when you buy this currency, euro USD, what you're doing is you're buying the euro. So it equals buying euro. And when you sell euro USD, that equals buying United States dollar. That's how that works. So that's why you can make money whether you buy or sell in Forex. So you got Y Forex, and then Forex pair, and then now the next part is knowing how money is made. Next part is knowing how money is made. So the biggest terminology when it comes to this is lot size. Now, lot size equals the size of your trade in capital. So the size of your trade in capital. Now I can go and tell you how each lot size is equal to a certain number of units of currency, but when you actually trade Forex, you don't really need to know the exact units of currency each lot size is. You just need to know how much you can make off of that trade. So the smallest lot size is 0.01 lot size. That's the smallest lot size. That lot size, is basically what you would trade if you had a $50 account. That lot size is also called a mini lot size. So, mini lot size. Not the next up, but the next commonly traded lot size would be our next number place. Next number place up would be the 0.1, which is called a micro lot. And then a commonly used lot size, especially when you have a bigger account, would be a standard lot. So would be a standard lot. So a standard lot is 0.10. And that's just basically the numeric values of the lot size. So standard lot. Now, the very next thing that comes after lot size that you would need to know is what is a pip. And the pip is basically, if you know, stocks use points. So stocks metric of profit is points. It's like, you know, Apple went up 100 points. Forex metric of profit is pips. So a pip, the way you measure a pip, how do you measure is on non-JPY pairs, and I'll show you the difference. The pip is the fourth number after decimal. After the decimal point. So for example, Euro USD could be like this, right? And the number 6 would be the pip value. Now in a Japanese yen pair, because Japanese yen, they don't use decimals. So it's 2 decimal points higher or lower, or yeah, higher. So yen pairs, for example, would look like this. So if I use the same numbers, in a yen pair, the second decimal point, or the second number after the decimal point, is the pip. So example, the number 6. So that's how that works, right? That's the next part. So what happens is you put the lots and pips together to understand profit. So an example is in a 0.01 lot, 1 pip would equal 10 cents. In US dollars. So if you go up 1 at a 0.1 lot, 1 pip is equal to $1. And then on a standard lot, one pip is equal to $10. Here's why Forex is so popular. The average pair moves 70 pips a day. That's the average. It's around 70 pips a day. So if you were to calculate 70 pips, and we do that again with 70 pips, at 0.1 lot size, 70 pips is equal to $7. In a 0.1 lot, 70 pips is equal to $70. And then on a standard lot, $70 pips is equal to $700. Here's the kicker. It's one trade. One trade, one day. You could place multiple trades a day. Now, if everybody had the choice, they would probably want to trade standard lots, but you would have to have certain account sizes to, I guess, safely or good risk management trade a lot size. So the trade, so I'll put it in 5 trades at a time, like capacity. So if we use 50 as a starting, so for 5.01 lot size trades, you would need roughly $50 to $100. For 5.1 trades, you would need, and it just kind of just goes up. It's simple. It's $500 to $1,000. And this is I'm just doing more so capacity now. This isn't a risk management class. So, this might be on like the upper to moderate to aggressive risk level, like if you actually use this as a risk management strategy, but we'll get into that later. So 5 standard lot trades, you would need 5,000. So $5,000 to $10,000. So if you think about it, if you had $50 to $100 and you placed 5 trades that went 70 pips, then you would make $35. You would nearly double or put a third. Well, that'll be half, almost half for a $100 account, and then it would be almost double for a $50 account as far as profit. Of course, there's percentages in trading. Not everybody wins every trade. But that's how that works. So you can see that, say if you had, $500 to $1,000 and you were able to trade 0.1 lots and have a 70 pip trade, then that would be 70, or, if you had 2 trades, 140, that's one day. So this is why Forex is such a big industry right now, because a lot of people are able to generate income if they know how to trade these markets from home, whenever they want, wherever they want. So let's see if there's any questions. in the chat. So non-Japanese yen pairs, you know, the second decimal point is the pip value. So you would count your pips based off the second decimal point. All righty. So let's continue. Let's continue on. What is so the next part? So we're putting everything, we're compacting everything. So the next part, when it comes to Forex, now that you know why Forex, what a Forex pair is, and how money is made, is how do you actually trade Forex? Like, how do you place an order and what type of orders? So to place a trade, you would need a trading platform. You know, that's pretty self-explanatory. The most commonly used trading platform is MetaTrader. Most commonly used trading platform is MetaTrader when it comes to Forex. You know, like in stocks, you'd have like Fidelity and Charles Schwab. So here's what you would use as far as like different order types, right? So order types. So of course you have your buy orders, and then you also have your sell orders. That's the only two things you can do in Forex is buy or sell. But the nature of the buyer, the nature of the sell can be different variations. So you have the first one, which is the most commonly used one, is market execution buy. So basically you are buying at current price. Then you have buy limit. And you can place a buy limit when you want to buy at a price lower than current price. At a price lower than current price. And then you have buy stop order when you want to buy at a price higher than current price. And I'll show you an example of what that looks like on a chart. Same thing for sell, you got market execution. You have sell limit. So market execution, you know, always remember that's current price. Then sell limit to sell at a higher price than current, and then sell stop to sell at a lower price than current price. That's how you place a trade. So we got that here. Let's move that down. That. All right. So let's demonstrate that real quick. So say we're here, right? Let's just say we are looking at this candle here, and I'm gonna get rid of that. We're looking at this candle here. This is the current candle. So even go far back and do that. Okay, we'll use this candle. So let's say we'll do buying first, right? So buying, if I'm buying at the price here, then this price, if I'm buying right now, like say we're in the markets at that time, this price here would be the market execution price. That would be the market execution price. Let's just say I feel like if price were to return to this area here, let's just say I feel like that would be a good buy. You know, for example. So that buy area, to place that trade at this moment, to place that trade, you would place a buy limit. And let's just say that I am looking to buy, like if price breaks above this point here. You know, a lot of people say that's a breakout trade, and I'll teach you breakout trades and what type of trades, like strategies, there are. But let's just say I want to buy when price gets up there. That would be a buy stop order. Now let's flip it to selling. Same price point. Of course, this would be the selling market execution, because you could buy or sell at whatever points. But up here, the way you place that trade, let's say if I want to sell when it gets up there, that would be a sell limit order. And then let's say if I want to sell when it gets down there, that would be a sell stop. So that's how the trades would work out as far as the types of trades. Your sell limit, buy limit, market execution, buy or sell, sell stop, buy stop. So the next part would be win the trade. And that depends on, you know, Forex sessions that you like to trade in. So you have 3 sessions, 3 major trading sessions in Forex. Got 3 major trading sessions. You have the Asian. We'll start with New York, since most of us in America. We'll start the New York session. You got the London, or the order, Asian session. You got the London session. And to be more precise, Tokyo session. The London session. Those are the 3 major financial hubs in the world. Now, time-wise, you know, it's going to vary depending on your time zone. I'm in Central Time, so I'll go based off of that. New York session would be 7 a.m. Central to 4 p.m. Central. Tokyo or Asian session would pick up right where New York left off of, and you would have 4 p.m. Central to 1 a.m. Central. And then London session would pick up right after the Asian session. This is why it's 24-hour markets. London session would be 1 a.m. Central to 10 a.m. Central. So now you know that they're just looking at that there's an overlap. So the London, they call it the London, New York, the London, New York overlap. Overlap, and they call it its own session, overlap session. The key here is that most volatile session, because you have two world markets open at the same time. It's the only time where you have two world market. And volatile just means, we'll just say busy, but volatile just means the amount of movement. So the busiest session, that would be 7 a.m. Central to 10 a.m. Central. So you got that there. So earlier we went over pairs, right? We went over pairs. So now we're going to go over the major currencies, because this is how that ties to the session. So you have the major currencies. You have United States dollar. You have the euro. We're going Canadian dollar. And I'm also going to use their abbreviations so you know what they are. I'll use gold as a currency. That's another commonly traded. So that's gold. Then you have the euro. So euro is usually represented like that, and the euro dollar. Then you have the Great British Pound. Then you have the Swiss franc. Swiss francs represented like that. Oh, Switzerland. And then you have the other European pair. Am I missing one? Oh, so the next one would be the Asian pair. So you have the Australian dollar. They call it the Aussie dollar as a nickname. You have the Japanese yen. So when you see these on Forex pairs, that way you know what they are. Japanese yen, and then you have the New Zealand dollar. So that's that, right? So major currencies there. So now the trick is knowing when to trade each currency. So if we go off the session, New York session, and it's pretty self-explanatory. Trade when that current country is up. So New York session would be US trading US dollar, Canadian dollar, And you would also trade gold because US and gold have a strong relationship as far as from a liquidity standpoint. The other session would be the London session. And that you would trade the British pound, the euro, and the Swiss franc. So if you see pairs with those symbols in it, those would be a good time to trade those pairs. And then the Asian session, you would trade the Aussie dollar, Japanese yen, and New Zealand dollar. And New Zealand dollar right there. So that's where you would like to trade those pairs during those times. You'll get the best movement for those pairs during that time. Now, the last part is knowing who the major players in the markets are. So the market participants. 95% of the liquidity are big institutions, banks, and governments, of course, because they print the money. 5% of the institutions, for 5%, are retail traders. Actually, I think when I last looked at it, it's 90 and 10. So we'll do that. So that's you and me right there. So big institutions, hedge funds, banks, and governments. And then you have the retail traders. That's basically it. So what you need to trade Forex is a Forex broker, just like you would need a stockbroker. Because that's where your money, you hold your money. Forex brokers provide, and they also provide liquidity to trade Forex on top of your capital. Provide liquidity to clients to trade Forex. Liquidity has another word in trading, and that's leverage. So when you go and open a broker account, you'll see something like 1 in 500 or 1 in 50, like 1 in 100. And then like you might see 1 500. Those are commonly used ones. And the other commonly used one is 1 in 200. Basically, the bigger, I'm not going to bore you with exact units, but the bigger the second number, the more trades you can take. Basically comes down to that. Now, risk management, you may do a 1 in 200 or 1 in 100, depending on how much money you got. Or if you want to be more aggressive, you would do a 1 in 500, so you can place more trades with lesser amounts of money. That's based off of you. But the rule is the bigger the second number, the more trades you can take at one time. That's the big rule there. Let's see here. The last term we go over is spread. And spread is basically how Forex brokers make money. That's why they give you, leverage, liquidity, and things like that. So you could think of it like commission or the cost of the trade. When you place that at the moment you place the trade. So, for example, if you look on your MetaTrader 4, you might look at like a pair. You might see spread. Spread is equal to 10. Let's just say 10. Spread is equal to 10. Well, what that means is when you place a trade, your price and actual price will differ by 1 pip. So like, for example, if you were placing a 0.01 trade and you had a spread 10, then your trading cost is 10 cents. Basically what you would have made with that 1 pip, because 10 is equal to 1 pip. And 1 spread is equal to 1 pipette, which is 1 more decimal place. So think of it like decimeter and centimeter. So a pipette, like a pip would be the decimeter, and a pipette would be the centimeter, the 1 decimal place behind it. Or, you know what I mean. So tenths and hundredths. We'll go with the actual term. So if a spread was a tenth, if a pip was a tenth, a pipette would be 100th. So see if we got any other parts of my basics. So basically this would conclude the language of Forex. If you know these aspects of trading, then you would know, exactly, you wouldn't be lost when it comes to placing trades, knowing what Forex is, knowing how trades are taken. The last thing is, account types. That was the last thing. I knew I was forgetting something. So you have a demo account, which is, like it says, is demo money, not real money, but real market prices. So you're able to trade the real market, not a simulation, but not with your actual money. And then you have a live account, which is real money backed. So whatever your balance is in a live account, that's your real actual money that you have in that account. So I hope that y'all got value from day one. Day two, we're going to get more into the technicals of trading, and we'll just keep stacking this up. What you want to do, for day one is make sure you have your demo account set up, and then also maybe go in and look at, for example, we talked about when the markets move. So like if we go here, let's pick, so Euro GBP has 2 pairs that trade in the London session. So you have the Euro and the Great British Pound. You'll notice that now that if you're looking here, this is tradingview.com. And if you go into setting I'll just teach you this real quick. If you go into setting your tradingview.com, like chart, you can go to would actually be in your settings. Time zone, there it is. So symbol time zone, you can change the time zone to your time zone. So I don't want to have standard time zone. So that way, when you look down here at the bottom, you'll see what the time is in military time, or a 24-hour clock. So I guess the homework would be to notice how you get more movement when a pair is in session. You know, because the more you look on the charts, the more familiar you become, the better you become in trading. So you want to have as much chart time as possible. So with that, that concludes day one. See you for day two.